You're listening to Ask the Expert on Sprott Money News.
Well, greetings once again to everybody out there at Sprott Money News and SprottMoney.com. This is your Ask the Expert segment for November 2017. I'm your host, Craig Hemke, and joining us this month is Danielle DiMartino Booth. Danielle is a Wall Street veteran who spent 9 years as an advisor to Richard Fisher and the Federal Reserve Bank of Dallas. She's now a best-selling author and analyst. Her book, Fed Up, an insider's take on why the Federal Reserve is bad for America, actually hit number 22 at Amazon, and it's still going strong. So it's a real pleasure to get a chance to visit with Danielle. And Danielle, thank you so much for your time.
I'm so happy to be here today. Thank you for yours.
All right, before we get started, one thing we always do is remind everybody about some of the advantages of Sprott Money. Again, if you do choose to sign up for precious metal storage with Sprott Money at this point, you get a free month of free storage. Everyone can visit SprottMoney.com for more info. Danielle, the way this works is we have been collecting questions from Sprott Money customers for about the past month. I've got 7 of them for you. So if you're ready, I'll hit you with number 1 and we'll just get rolling.
Let's do this.
Okay, here we go. Question number 1. In the next financial crisis, because we all know, with economic cycles, there's going to be one at some point. So in the next financial crisis, do you see the U.S. dollar strengthening or weakening? And then on top of that, do you envision a time when the U.S. dollar is no longer the sole reserve currency for the world?
Well, first of all, I'm happy that you recognize, unlike Chair Janet Yellen, that we will have another financial crisis in our lifetime. I think that's very mature of you, because she opined recently in London that we would not see another financial crisis in our lifetimes. But to get to your question, I don't think that there is enough compatibility among major superpower economies to move to something like a basket of currencies. So I would suspect that the U.S. dollar would remain the source of strength, would remain a flight to safety haven currency in the next crisis. But to answer your second question, I'll tell you that all 4 of my children are forced to take Mandarin as a very long-term career path for them, because I do have concerns that as we continue degrading the value of the dollar, pretending like debt does not matter, that one day the dollar will indeed be unseated. And I think that the country that has its eye on that prize is China. And not to get too doom and gloom, but simply purely historically speaking, reserve currency status does not typically fall without an actual war happening after what has started as a currency war and morphed into a trade war. I hope that answers your question.
Yeah, it sure does. And that has been the history in the past, no doubt about it. One thing I always note, it seems like there's very few people left alive that have ever lived in a world where the U.S. dollar wasn't the sole reserve currency. And so it's kind of hard to imagine, but it sounds like it's at least a possibility in your mind.
I do. But again, it's not, the Chinese do not have enough wherewithal right now, speaking in terms of pure cash liquidity, to withstand another crisis and have the yuan take over as reserve currency status. But it'll be interesting to see what the opposite end of this looks like.
Gotcha. Okay, moving on to question number 2. As the Fed appears set to hike the Fed funds rate again next month, is the inverting yield curve a self-fulfilling prophecy of recession simply due to the higher consumer interest costs that those interest rates bring?
Well, I find it to be very disturbing. One of my followers on Twitter recently tweeted out some old Ben Bernanke commentary from some old congressional testimony, with him saying that an inverted yield curve initially harms banks, but won't necessarily lead to recession. And Ben Bernanke is supposedly a great historian. And, we had another central bank president very recently, Charlie Evans of the Chicago Fed, basically say the same exact thing. My answer is that defies history. And I get really, really worried when anybody, no matter how nicely they cage it, tries to suggest to me that this time is different, because it's never different. Inverted yield curves always lead to recessions because of how overstretched the economy is at this juncture, and because of how long the current recovery and bull market have been going, my greatest concern is that an inverted yield curve might take not even a year to land us in recession, that we might have a shorter time frame between inversion and hitting recession than we've typically had historically.
I think the next question then follows right up with that, Danielle. We're recording this here on Friday the 17th. It was just yesterday, last evening actually, that San Francisco Fed President Williams stated that more QE and even negative interest rates might be used to combat the next recession. Do you agree with that?
No, these are the things that keep me up at night. These are the things that get me fed up. I'm frightened when I see the enthusiasm, if you will, around things like Bitcoin, which I think is a flat out bubble. It's a reflection of anxiety, of course, in fiat currencies as well. But central bankers have their eye on blockchain specifically because they see what's happening in cryptocurrencies as building the infrastructure to come in and implement negative interest rates and eradicate cash. And these are the things that really, really, really scare me because they might seem to work on paper for some neo-Keynesian on steroids, but they don't work in practice.
And we've seen that almost play out, maybe not necessarily on purpose, in Europe, right? Remember, didn't the 10-year German Bund got well below zero, and there's still a lot of negative rates around the world.
There's still trillions of dollars of negative debt around the world. But in the most recent episode, when we saw high yield here in the United States sneeze, in Europe, where European high yields have been high yield bonds, where their yields have been trading south of U.S. 5-year Treasury notes yields, we saw the sneeze in the U.S. high yield market become an influenza in Europe. And that tells you that the more negative a rate is, the easier it's going to be to lose principal on that bond you own. I want to shake the hands of the people who didn't manage to get into Argentina's 100-year century bond because it was so oversubscribed. I want to go find the people who were like, darn, I didn't get my allocation, and I want to tell them that was a good day in their life.
They lucked out. That's right. Well, you know what? That's an excellent segue to question number 4, Danielle. This is kind of a little different question in a sense, in that this person wants to know how a small investor could conservatively invest in low debt countries like some of the BRICS. This person's probably trying to look over the horizon and thinks that's the place to be. Do you have any suggestions, any thoughts on that matter?
Well, there was an interesting Barron's article a few weeks ago about how J.P. Morgan and others are trying to establish indices in China, to take one example. I'm actually fairly constructive on the middle class rising up in China over the next 10, 20 years, and I think that might be a good place to try and find some safe fixed income. But in the interim, I would suggest that even small investors can gain access and do their homework on some good municipal bonds here in the United States. That's how I personally have tended to get extra yield, because municipals tend to throw the baby out with the bathwater every time something happens in Puerto Rico or Illinois. Whereas there are many good states, most of which start with I besides Illinois, that have well-run pensions, that have good solid debt where small individuals can go and find a place to get a step up on their yield. But be careful.
Yeah, you got to do your homework on that, no doubt. Okay, we're more than halfway through already, Danielle. So I'm going to move on to question number 5. I guess this gets to physical gold and silver ownership, which I don't know if you own any. This person wants to know if you personally have an allocation to physical gold or silver, and if so, in which form?
Well, so I do not personally have any ownership of gold. However, and a lot of that has to do with the fact that I think that until there is a true inflection point, that gold is going to keep doing what it's been doing, which is kind of nothing, for several years. But when we do have a true inflection point, I would certainly look to some of the more undervalued mining stocks that are out there. But again, I am no expert when it comes to gold. My opinion on gold, and the reason I will own it in the future, is because of my experience, my 9 years of experience inside the Federal Reserve during the heat of the financial crisis, in which investors had to learn the hard way, again, because these are not new lessons, but investors had to relearn the lesson that when bubbles erupt, as these are apt to do in commercial real estate, in the bond market, in the stock market, that correlations line up perfectly. And that most of your asset classes are going to lose value in concert, and there will be no place to hide except for the precious metals complex. So I consider it to be the truest of all safe haven trades.
Just not quite that time yet. Yeah, I wonder. And I'm going to add on.
But bubbles are weird things. Bubbles are very, very weird things. And this time next year, in theory, we will have $800 billion less in run rate of global quantitative easing between what the Fed has proposed in shrinking its balance sheet and what Mario Draghi has committed to do in terms of tapering the ECB's purchases. If that's the case, that $800 billion in the negative on an annual run rate, by the time we hit the holiday season next year, that will be material enough to have created an inflection point. But here's the big if, and that's truly if the central bankers of the world don't blink and say, no, we're going to start blowing up our balance sheets again. These are very tenuous times.
Yeah. Again, Danielle, it's almost like you were helping me produce this, and that's a perfect segue to the next question, frankly. And this has to do with central bank policy, particularly the Bank of Japan and the Swiss National Bank, where they are just overtly printing fiat and buying equities. In the case of Bank of Japan, they're a major owner of Japanese ETFs. How do these massive positions in equities ever get unwound, or are they simply due to continue indefinitely?
Well, it's a fascinating question that you ask. When I was on the inside and the Fed was finally compelled to taper its purchases of mortgage-backed securities and treasuries, it had to do more with mechanics than any kind of trying to make a statement about being more hawkish or tightening policy. Because if you might have noticed, it was Ben Bernanke and a ton of doves outside of people like my former boss, Richard Fisher. I think that the problem is going to be with a lot of these banks, mechanics going forward. Japan is a place where you cannot lose faith. And it's a very different culture from one that we understand. In America, we have no problem coming out publicly and being critical of others. But it was really remarkable a few months ago when the head of the largest stock exchange in Tokyo came out publicly and asked Kuroda to stop buying stocks because he was crowding out the natural buyers and creating this tremendous atrophy and stagnation in the stock market. And these are the types of problems that will become endemic as the cycle turns. And if you consider not just the Swiss National Bank, not just the Bank of Japan, but so many sovereign wealth funds that also have huge stakes in the stock market, if what happens combined with passive investing, if we've got too many gigantic players heading for the exit at the same time, when nobody can define right now what the size and scope of the exit looks like. We only know what the entrance looks like, which is infinity.
Yeah, that's an excellent point. Well, all right, Danielle, we've got one last question. And I saved this for last, as it turns out, because I thought this was kind of a fun question to pose to you. There's a lot of talk on the internet and in other spaces about the what was begun as the President's Working Group on Financial Markets, right? You heard about that, obviously. Some folks call it the Plunge Protection Team. In your experience in working at the Fed, is that an active participant in the market still today on a daily basis?
Well, for those who have read my book, they will figure out that I'm public enemy number one to the conspiracy theorists. So it is in times of acute financial distress that this theoretical team comes out of the woodwork. And I actually write about it in the book.
Okay.
But I can tell you from the time that I was at the Fed that the problem was not necessarily crashing stock prices, which would tend to bring the plunge protection team out of the shadows, et cetera. It was really a much more complex problem at the time with liquidity in the credit markets that had to be resolved, and it was very publicly resolved as opposed to anything covert with all of the liquidity facilities that were rolled out by the New York Fed to address the different pockets of frozen credit markets that were endemic at the time. But I will tell you that it was those credit facilities that saved the day way back when, not lowering interest rates to the zero bound. And that's always been where my beef was with the Fed, was that we could have solved the most acute problems of the financial crisis. And the financial crisis, of course, was created by the Fed. The housing bubble was created by one Alan Greenspan. But the problems of the crisis could have been resolved using liquidity, and we never really had to go past a 2% floor to get there, which in turn, we ignored that fact, went to the zero bound, and created the distortions that we have now in the financial markets, and created the body of evidence that suggested that negative interest rates would be a better way to go, which central banks followed in Europe and in Japan.
So do you think, Danielle, have they learned anything between crises, if, as President Williams suggested last night, that they're just going to simply take the zero bound and move it to like a -2 bound?
Yeah, no, that shows that they really have not learned anything. And the problem is that they cannot see past their models to the ramifications of overvaluation until after the world has blown up. And then they're going to come back in with the same exact models. You know, Bernanke recently came out with a paper of his own that suggested that during times of financial disruption, the way that we could resolve the issue would be to raise the inflation target to 3 or 4% from its current 2%. Well, as long as you're mismeasuring inflation and you can never get it to 2%, raising it to 3 or 4% and that creating license to do more quantitative easing or push interest rates into negative territory is simply going to produce more financial instability. And, you know, Einstein was actually never quoted as saying as defining what insanity was. He's often misquoted. I don't know who said it, but it is the mantra by which central bankers live.
That's
trying the same thing over and over again, trying for different results.
And that is about what President Williams said last night. He said, yeah, maybe we'll have to move that inflation target up. That'll help too. Oh, my goodness. Well,
I hope not. I really do.
Yeah. Well, I guess we're going to find out soon enough. Danielle, thank you so much. This has been extraordinarily insightful. Again, we've been speaking with Danielle DiMartino Booth. She is the author of the best-selling book, Fed Up, An Insider's Take on Why the Federal Reserve is Bad for America. I think everybody should buy a copy and check it out. Danielle, thank you so much for your time.
Thank you. I appreciate it.
And from all of us here at Sprott Money News and SprottMoney.com, thank you for listening. Be sure to check out our holiday catalog on the way out. You can find it online at SprottMoney.com. Again, thanks for listening. We'll talk to you again next month.